On Business Incorporated today, South African manufacturing sentiment rises to highest level in almost 23 years. Tanzania gold exports fall 10.4% in 12 months. And Mozambique signs agreement with the United States to receive aid worth $1.5 billion. Hello and welcome to the program. I'm Will Ibang. We begin with market numbers from Africa, where trading sentiments were mixed at intraday. Nigeria's main index was in the red at intraday, down 0.27%, while South Africa's index was in the green, up almost 0.5%. Egypt's equities market closed on Thursday. However, its index was down by 0.01%. The Nairobi Stock Exchange ended Thursday's trading session in negative territory. Now to the Middle East, where major equities closed Thursday mixed. The Abu Dhabi and Dubai indexes both traded in opposite territories. Abu Dhabi was down 0.21%, while Dubai inched up by 0.09%. Still within the region, Saudi Arabia closed in the green on Thursday, up 0.4%, while the Qatari index lost 0.18% to close. Now to Europe, where Europe's gas standoff with Russia is again at the top of today's agenda after Putin threatened to cut off Europe's gas supply if the countries do not pay for gas in rubles. What happened to that ultimatum? Rob Watts is in Berlin with the updates. Hi, Rob. The standoff between the EU and Russia over gas has moved up a notch since we last spoke. What's the latest?
Yes, President Vladimir Putin yesterday set foreign buyers a deadline of today to begin paying for their gas in rubles. If not, he said, they would have their supplies cut. Now, this is a continuation of the brinkmanship that we've seen over recent days, with Putin banking on European countries being worried enough about the impact of losing Russian gas on consumers back home to hand Putin a victory. Now, President Putin says customers will have to use special Gazprom Bank accounts to pay, and that Gazprom Bank would buy the rubles and the gas on behalf of the client. However, Germany, which gets half of its natural gas from Russia, remember, says it's not backing down either. Berlin has accused the Russian government of blackmail, in fact, and it's insisting that payments will continue in euros. Now, although the setting and passing of this deadline is very sudden, European countries are reportedly not due to make another payment until the middle of May, so that does leave at least some breathing space and potentially some time to find a solution to the impasse, even if neither side currently looks likely to back down.
Talking about breathing spaces, the EU leaders are due to hold talks with China's leadership. What message will they have for Beijing?
Well, the key thing that European Commission President Ursula von der Leyen and European Council President Charles Michel will want to stress to the Chinese is that they must not support Russia in its war in Ukraine. Now, ahead of their meeting, EU officials have actually said that if Beijing were to supply weapons to Moscow or help it to evade Western sanctions, that would carry consequences. In particular, it would harm relations with China's two biggest trading partners, the EU and the United States. Now, trade relations actually between Brussels and Beijing are already strained ahead of the war of Ukraine. The two sides concluded an investment agreement way back in 2020. However, it's currently on hold. The two sides are also in dispute over China's alleged human rights abuses in the Xinjiang region, and China's also in dispute specifically with EU member Lithuania after it allowed Taiwan to open a de facto embassy there. That obviously upset China because it considers Taiwan part of China. So there are plenty of issues to discuss between leaders in Brussels and China's Xi Jinping.
Now, a new month begins on the market. So, well, talking about the second quarter now, will traders be glad to see the back of the first quarter?
Well, they certainly will. It was the worst quarter for European markets since the start of the pandemic 2 years ago. The pan-European stocks 600 lost 6% of its value over the last 3 months. It was a quarter really where worry piled upon worry. Markets started the year, you may remember, being plunged into turmoil over central banks' plans to tackle rising inflation. We had announcements of interest rates rising and the withdrawal of stimulus programs. We also saw investors cashing out after a near 2-year rally, encouraged by government support for businesses. And then in February, we, of course, had Russia's invasion of Ukraine, which has had a dramatic impact on equities as well as commodities markets, of course. And despite something of a rally over the past couple of weeks, European markets ended the quarter in the red. What about the next 3 months, you may ask? Well, who knows? I mean, the war in Ukraine is continuing and the US Federal Reserve is only now getting started on its campaign of rates hikes, but it will have to go some way to be a worse quarter on markets than Q1.
Thank you so much, Rob, for that insight. We'll keep looking out for what's happening in that space. Thank you so much again. Now we move over to Asia, where shares in Asia Pacific were mixed in the first trading day of the new quarter as trade private surveys showed Chinese manufacturing activity shrank in March. Chinese tech stocks in Hong Kong saw sizable losses, with Alibaba falling 2.94% and Baidu plunging 5.16%. JD.com shed 2.91%. The Hang Seng Tech Index declined 1.25%. Hong Kong's broader Hang Seng Index shed 0.19% as of its final hour of trading. Now, in mainland China, the Shanghai Composite rose 0.94% to end the trading day, while Shenzhen Composite climbed 0.9%. Elsewhere in Asia, the Nikkei 225 in Japan slipped 0.56%, while the Topix Index fell 0.11%. In South Korea, the Kospi dipped 0.65%, while Australia's S&P SAX 200 declined fractionally. Now, stocks rose in early trade on Friday as investors assessed a new quarter of trading and a troublesome bond market recession indicator. Dow futures gained 0.25%, S&P 500 futures added 0.4%, and Nasdaq 100 futures rose 0.3%. Investors were also awaiting the official jobs report for March, expected to be released later today by the Labor Department. Meanwhile, let's check out yesterday's trading activities on Wall Street with Maria Bird.
The U.S. stock market fell on Thursday, having one of its lowest days since 2020. It's the lowest quarterly close since 2018. The S&P 500 fell by 1.6%, the Nasdaq by 1.5%, and the Dow Jones was down by 1.6%. It is clear that investors are a bit concerned about inflation and a rise in energy costs, despite President Biden's announcement that he will be tapping into millions of reserves of oil to try to decrease energy costs and to stabilize inflation.
Now to check in on global oil space, oil prices seesawed early on Friday ahead of a meeting of consuming nations to discuss a new release of emergency oil reserves alongside a huge planned release by the United States. West Texas Intermediate crude futures dipped 6 cents to $100.22 after trading as high as $101.75. The contract slumped 7% on Thursday. Brent crude futures rose 5 cents to $104.76 a barrel after dropping 5.6% on Thursday. The May contract expired on Thursday at $107.91. Meanwhile, International Energy Agency member countries are set to meet today to discuss a further emergency oil release that would follow their March 1 agreement to release around 60 million barrels of oil. OPEC Plus has resisted pressure to pump more crude, sticking to its gradual release of 400,000 barrels per day. Meanwhile, traders are waiting to see how much oil the IEA countries agreed to release, but do not expect it to have much long-term effect on the market. Gold prices eased early on Friday, widening their weekly losses as a stronger dollar outweighed safe haven demand fueled by a lack of progress in Russia-Ukraine peace talks, while investors awaited March U.S. jobs data for policy tightening clues. Spot gold was down 0.2%, while U.S. gold futures fell 0.7%. The metal has lost about 1.1% this week. Spot silver edged 0.2% higher to $24.73 per ounce. Platinum was up 0.1%, while palladium rose 0.9%. Both metals were on course for a fourth consecutive weekly loss. Investors are looking forward to the March U.S. jobs data due later in the day for wage inflation and cues on the monetary policy stance of the Federal Reserve going forward. Now we move quickly to Africa, where in a bid to contribute to poverty alleviation, a Nigerian school is targeting students from poor families to give them a chance to excel at science, technology, engineering, and mathematics for 100 naira, that's about 25 cents, for a fee a day, hoping they can hone their skills that can help their families climb out of poverty. Faridat Bakare, a 12-year-old student, has developed a solar-powered prototype car as she set her eyes on becoming an engineer.
A Nigerian school is targeting students from poor families to give them a chance to excel at science, maths, and engineering for a fee of 100 naira a day, hoping they can hone skills to help their families escape poverty. One student, 12-year-old Faridat Bakare, who enrolled at NOSC Secondary School in Abuja in 2020, a year after it opened, has set her sights on becoming an engineer. In a technical lab at the school, she shows off a prototype for a solar-powered car made from boards, which she developed with her classmates.
I want to become an electrical engineer who works with robots, solar panels, and all the connection of all the snap circuits, all things like that.
North School runs largely on donations, and school officials visit each family to establish that they have no capacity to pay full fees, which would work out at 66,000 naira a term.
When we decided to run the North School, we had to ask ourselves, what kind of education does the poor man's child need to break out of poverty? That's what we set out to do. We didn't set out to open a classroom and say, oh, there's another new school for poor children. No. We said, how can we fuse into learning for the poor enough value that they can break out of poverty?
For the 100 naira a day fee they pay, students are given uniforms, books, lunch, and girls are given sanitary pads once a month.
We will continue a generation of millions of people that are not very literate, that are not very productive, that will continually remain under the poverty line and perpetuate another generation of poverty. And I'm saying there's something we can do about it. We can't reach everybody, but for every one child that we can get out of the street and give this empowering education, I see it is victory and it's a great, great contribution to building a great nation and just society.
At least 10.5 million children in Nigeria do not attend school, and that's the highest rate in the world. Most affected are girls, children with disability, and those from poor households. Students at North spend 75% of their time studying science, technology, engineering, and mathematics. When they graduate, each student has to develop a prototype of something they can use or pursue after school.
I didn't know how to use the laptop, the monitors, and all this. So now in the Knox under Naira school, I've made solar car, I've made solar itself, and I've used solar to charge a phone.
Her mother, Fausat Bakare, sells cassava grains at the Kuje market, an outdoor market mostly for local foodstuff and household items in Abuja. North School runs a rigorous competitive selection process that takes between 3 to 5 months before a student is finally taken in. The goal for the Bagwells is to set up more of such schools in Nigeria and the rest of Africa.
Now, reducing poverty one child at a time. Now, after the break, more stories from the African continent. Do stay with us. Welcome back. South Africa's government says it will reduce its general fuel levy temporarily and sell part of its strategic oil reserves to soften the impact of rising crude prices stemming from Russia's invasion of Ukraine. According to the country's finance minister, the duty imposed on each litre of fuel will be reduced by almost 40% from April the 6th until May the 31st this year. Now, to talk about this, I'm joined by Matt Kindiger, practice lead Sub-Saharan Africa at Frontier View. Hi, Matt. Good to see you.
Hi, thanks for having me on the program today.
Yes. Matt, before we kick off, I just have this question. This 40% discount or cut that the government is planning, how do you think they want to fund this? Is this some kind of subsidy?
That's a good question. So the South African government's public finances are quite tight at the moment. It does have quite limited scope to sustain more subsidized fuel prices in South Africa. What the government has seen over the last couple of months is a significant improvement in revenues, more than it expected. And this is because of the very high global commodity prices, especially for things like coal, iron ore, and metals. So there is some scope for the government to subsidize fuel prices, but we don't expect this to be sustainable in the long term.
Okay, so how high will fuel prices, do you think fuel prices and inflation rates will go in South Africa this year? What's your projection?
Yeah, certainly. So there is scope for fuel prices to rise further, especially if the government can no longer sustain subsidizing fuel in the country. Our base case here at Frontier View is that global oil prices will probably remain above $100 a barrel over the next couple of months, and there is some scope for them to rise as far as $150 a barrel or above for weeks at a time throughout the year. And this is because of relatively strong global demand, and also because we are expecting Russian supplies to fall simply because of the existing sanctions having an effect on oil services companies operating in Russia. So we are seeing gradually declining supply and increased demand. And this is despite the fact that OPEC is going to be increasing production. In South Africa, as we've said, the government will struggle to continue to subsidize fuel prices over the long term. So there is a limit to how low the government can keep prices. And in terms of inflation, so fuel prices definitely inform the inflation outlook in South Africa. We are now expecting inflation to average 7.5% year on year in South Africa in 2022. Bear in mind, this is a substantial upward revision from our previous forecast for this year of about 5%. So this is well above the South African Reserve Bank's upper target limit of 6% year on year. And this also will represent the highest annual inflation rate since at least 2008. So quite a significant increase in inflationary pressure in South Africa.
Okay, so you're saying that you expect the South African Reserve Bank to respond to this rise in inflation. Is that it?
Well, yes, certainly we would expect the South African Reserve Bank to do something, notably increase interest rates. So interest rates did fall to a record low during the start of the pandemic of about 3.5%. The South African Reserve Bank was very keen to support the economy through the difficulties caused by COVID. And this is well below the pre-COVID levels that we were seeing of about 6 or 7%. So the Monetary Policy Committee has already begun to tighten and raise interest rates. From the end of 2021, it raised interest rates from 3.5% to about 4.5% now. And if we see further surges in inflation, this is likely to continue. Additionally, the economy is expected to perform relatively well in Q2 and Q3 because of very strong demand for export revenues. So this provides additional space for the Reserve Bank to increase interest rates. However, we don't think the South African Reserve Bank will be very aggressive with its interest rate increases. And this is because although export revenues are quite strong in South Africa at the moment and will be for the next few months, consumers and businesses are extremely sensitive to high interest rates, and this is because of very high unemployment and quite weak domestic demand in the economy. So the South African Reserve Bank will need to strike a balance between containing inflationary pressure but not stifling out credit growth, which has been so important for the economy over the last couple of years.
Could you be more specific about the challenges that these businesses are facing in this high inflation environment?
Yes, certainly. So it's worth remembering that even though we're expecting inflation to average about 7.5% this year in South Africa, producer prices, which are a measure of the costs that businesses are facing before they sell their products, have already reached a record high. So producer price inflation reached a record high of 10.8% year on year in December 2021, and they were at 10.5% in February. And so this is really, represents really significant cost pressures for businesses. And what they're struggling to do is pass these cost increases onto their customers in the form of higher prices. And this is because domestic demand in South Africa still is quite weak. And so what we're going to see is companies facing quite significantly squeezed margins over the next couple of months and potentially well into 2023. They're going to have to find ways of adjusting to very price-sensitive customers for the next 6 to 12 months. They've got to find ways of saving costs or making their offerings, both their products and their services, more attractive to their customers. And there's also something they have to bear in mind is that if the cost of credit increases, they may also begin to see issues with cash flow. So they may also have to start postponing some capital investment. So a number of challenges on the horizon for businesses in South Africa.
Thank you, Matt, for that. It's always good to speak to you. Matt Kindiger, Practice Lead, Sub-Saharan Africa, in front of you. Thank you so much for joining us today.
Thanks again.
Now, meanwhile, South African manufacturing sentiment has risen to the highest level in almost 23 years. According to the Bureau for Economic Research, the Purchasing Managers Index climbed to 60 points in March from 58.6 recorded in February, remaining above the 50-point mark. Data suggests that conditions in the manufacturing industry hit hard by coronavirus lockdown restrictions. Global supply chain disruptions are starting to normalize. However, concerns about stagflation and the impact of Russia's invasion of Ukraine pose a risk to the outlook. Now, Tanzania's gold exports has declined by 10.4% from $2.97 billion to $2.66 billion in 12 months to January, and that's according to the country's central bank. The central bank attributes this drop mainly to a slowdown in production. It further adds that gold exports accounts for almost 39% of Tanzania's total exports of goods and services in the year ending January. The bank says gold prices have remained unchanged and above pre-pandemic levels, continuing to reflect its appeal as a safe haven. However, the price of gold rose by 1.5% in January due to rising inflation that lowered the treasury yields in the United States. Now, the Mozambican and United States governments have signed an agreement under which $1.5 billion of aid will be provided to Mozambique over the next 5 years. According to a statement by the U.S. Embassy, the partnership between the Mozambican government and the United States Agency for International Development seeks to promote a more peaceful, prosperous, and healthy Mozambique. It adds that the 5-year strategy will increase support for northern and central Mozambique to withstand the shocks of natural disasters, violent extremism, and food insecurity. It also intends to promote a business environment that allows diverse and inclusive growth by assisting Mozambique to develop more transparent, accountable public financial management. The strategy will also focus on building gender equality and increasing economic opportunities for the youth. And that's it on Business Incorporated. Thanks for watching. I'm Willie Bung. See you next time.